Okay, so welcome to video number 8. Video number 7, we concluded we were working on the unadjusted trial balance. And as I was saying, the unadjusted trial balance is simply a report that lists all the debit balances and all the credit balances that you have booked up to that moment, which would include all the transactions excluding adjusting entries, right? I think I finished off around here. I went ahead and finished it. So all these entries are simply the ending balances that I had in the ledger accounts over here. And so as we can see, the total debits match the total credits, which is $611,000. And so that's fine. And so the next step is going to be to post the adjusting entries. Once we post the adjusting entries, we can go ahead and build the adjusted trial balance, which is going to be something very similar to this here, except that it's going to include adjusting entries that we have made, right? So let's go back to the story and let's take a look at the adjusting entries. So we see that the first adjusting entry that we want to do is, adjust the prepaid expenses. In December, we have prepaid $24,000 of rent in December of 2014 for the full year 2015, which would be $2,000 per month. And as you can see here, we establish a prepaid rent account of $24,000. Well, 1 month's rent has passed by. So on January 31, 2015, we're going to go ahead and we're going to adjust the prepaid expenses. Now the prepaid expense has a balance of $24,000, which we have already established. If we look over here, we see prepaid expenses. It should be somewhere around here in the asset. Prepaid rent, $24,000. So we want to reduce that by $2,000. So at the end of the period, January 31, we're going to expense $2,000 of the prepaid rent. And so the entry to make to that would be a credit to prepaid expense to lower it by $2,000 and recognition of $2,000 of rent expense. Okay. So second adjusting entry. Well, turns out that we delivered 1/2 of the $6,000 of the order that was paid in advance. So we fulfilled and we earned half of that $6,000. So we can go ahead and record this entry. And the transaction gives me further information that the cost of the candies that were delivered was $2,000. So we need to know the cost if we want to enter this entry. So the unearned revenue liability is going to go down by 1/2, right? So the correct entry there would be to reduce the unearned revenue liability by $3,000. So that will be done with a debit to the unearned revenue account. You are going to recognize sales revenues of $3,000 in the month of January. And as the transaction says, there was a cost of goods sold of $2,000. So that means that you're finally going to recognize the expense. And the inventory actually went out. So $2,000 of inventory that went out. And so this is the full transaction. Here we have the effect on the balance sheet. The effect is going to be net income of $1,000, right? Revenue of $3,000, cost of goods sold of $2,000. You reduce your unearned revenue by $3,000 and you reduce your inventory by $2,000. Okay, so the next entry, accrued revenues. NLA will accrue the portion of interest income pertaining to the month of January for their $50,000 investment. Okay, so let's see what we would do there. I had already prepared this and I had already done the calculations, right? So 50,000 times 4% divided by 12 because we're only accruing 1 month. Well, that came out to $167. So I'm going to go ahead and recognize the interest income of $167. That's going to be revenue
on the revenue side for me, and I'm going to create an asset, interest receivable of $167. Okay, so we're accruing an income whose cash flow has not been received yet. Fourth adjusting entry, I should say, accrued expenses. Utilities and water bill for $600 for the month was received and will be paid in the first week of February. So we received the bill and we know it's going to be for $600. So we could go ahead and accrue it with confidence, even though we're going to pay it the following month, the following week. So these are expenses that you want to recognize in the month whose cash outflow has not occurred yet. So utilities expense for the month is $600 and accounts payable is going to be $600. Okay, you increase your expense and you also increase your liability. There appears to be another accrued expense. Interest expense on the loan is accrued for the month. So this is very similar to the interest income, except it's an expense. So let's see, what do we do here? We are going to we're going to calculate the interest expense for the month, which is $100,000 times 5% divided by 12. That's going to be $417. We're going to recognize the interest expense, and we're also going to create a liability because in this case we have to pay that in the future, in the next month, or whenever it's due, $417. It doesn't matter when you're going to pay it, but the important thing is that you want to recognize the expense this month. That's the matching expense principle, right? That's the expense that pertains to that month. End of month supply showed the store had a $1,000 in supplies for use the following month. Okay, so the store had a $1,000 end of month supply. So how are we going to calculate this? So we're going to sort of work our way backwards. We are going to say, okay, I know that I purchased $2,000, right? That was my initial purchase. That was done in December. You see, $2,000. And then I went ahead and I purchased another. $500 in January. So I purchased 2,500, but I ended up with 1,000. That means I must have used 1,500, right? It's an easier way to calculate supplies expense rather than try to track it one by one, because they are a bunch of little items. So we sort of work our way backward. Purchases minus beginning balance plus purchases minus ending balance is going to equal your supplies expense. So that turns out to be 1,500, which we book as an expense, and we are going to lower the supplies account by 1,500. Okay? Now we need to record the depreciation expense related to the equipment purchased. And remember, I had the I had the issue whether I couldn't remember if it should be 10 years or 8 years. So I sort of looked at here and was able to figure out that I used 8 years. So my depreciation expense is going to be $833, and I'm going to put it in what's called a contra account. This is going to be paired with the equipment account, except that it's going to lower it. So $80,000 is going to be lowered by $833. And let's see if I did the calculation correctly, right? So I had, let's just do it right here real quick. I had $80,000, right? 80, 1, 2, 3. And I divide that by, it was 8 years, right? So that's $10,000 per year, and then that I divide by 12, and it's going to be 833. I rounded this off, right? So 833 is my depreciation expense. And like I said, this accumulated depreciation account is what we call a contra account. That one is combined with the equipment account, which has a debit balance, and the net is going to be the net book value of equipment. Okay?
So what's the last adjusting entry? Well, the last adjusting entry is taxes, but I like to leave taxes, and I'm pretty sure most people would like to leave taxes till after you sort of created a pre-tax, um, after you've created a before tax income statement, because how do you know what taxes you're going to record? You first have to post the journal entries for, first you have to post the adjusting entries and then do a calculation of what your net income before taxes is, so that then you could book your taxes, right? So let's start the posting process now. Now we'll go to the January of 2015 general ledger, and we're going to start the posting process. Okay, so the rent expense was one of my first entries, right? And I've highlighted the ones where I did adjusting entries. So prepaid rent goes down by $2,000. Now we have a $22,000 balance, which is what I wanted. There's going to be rent expense right here. That's the offsetting entry. Rent expense for $2,000. Okay. What was the second transaction? Unearned revenue. So unearned revenue was a liability, right? And I know that I lowered my liability. I believe it was by $3,000, right? Yeah, unearned revenue went down by $3,000. I recognize sales revenue of $3,000. I recognize the expense of the inventory when I purchased it at that point. So inventory is going to go down. Sorry, recognizing the expense would be cost of goods sold, right? That's the right terminology, recognizing the expense. And of course, the inventory goes down by $2,000. Inventory goes down by $2,000. Okay. Now we're going to post the interest receivable from the short-term investment that we made, $167. We're going to recognize the interest income here of $167 for that month, even though we have not received the cash. Utilities expense. Utilities expense, we want to recognize that, right? Because we received the bill even though we haven't paid it, but the bill pertains to that month, so we want to do that. And we'll just put it in our accounts payable or utilities payable if you have a separate account, right? Let's go and let's post the interest expense and interest payable. Interest expense right here, 417. Interest payable over here, will 417. Okay, I'm trying to do this as fast as possible to fit it into the into this video. Supplies expense and supplies. Okay, so supplies we know went down, and I believe it was 1,500, right? And we are going to recognize that as supplies expense for the period, 1,500. Supplies expense for the period is 1,500, and then we're going to book the depreciation expense. Let's do that first. The expense we book it here is $833, and then we accumulated depreciation is a reduction in the value of equipment. But as you can see, we put it in its own account. Now, when we present it, we could present these two together. So 8,000 minus 833 is going to be the net book value of the equipment. Okay, so excuse me. So now we've built. I already had this linked. So now the ending balances of these new accounts are put here in the adjusted trial balance. And hopefully they will match. So they do match. And 613,017. And so we have a balance sheet that balances. Okay. And now
the next step, I'll continue in the next video, okay?